In this video, we are going to discuss the topic of mean reversion trading, discuss what it is, how you can go about accomplishing it, at least using Tradingview, and get right into mean reversion trading. Guys, before I get in the video, please make sure to like, comment, subscribe, and use the affiliate links in the description box below. Apex Trader Funding 80% off using the coupon code in the link below, description box below. Okay, guys. Mean reversion trading refers to a style of trading in which you bet on the market reverting back to an average price or reverting back to an average price, basically. And there's a few different ways to go about it. But the content of this video is not going to be too long because it's pretty easy to understand. So how do we go about doing this? Well, first off, if we're here on Tradingview and I'm on Tradingview desktop, I have a list of futures that I can trade using my Apex Trader Funding or any other funding company, but using or TradeStation or using Tradingview. What you can do is you can line up the futures contracts that you are interested in looking at on a watch list, and that they will appear here on the list to the right. What you're going to want to do is you're going to want to sort by change, and this updates when these markets close every evening, guys, and when they reopen. And all you want to do to highlight some instruments that you might consider mean reversion is look at the greatest extreme. So for example, our palladium futures are down the most right now. They're down, platinum futures are down 6.9 or 0.67. That is the greatest loser on the overnight session. Now, if we go and sort by change to positive, we can see that corn futures are our greatest gainer on the overnight session. But guys, when you're trading in the overnight session, you're trading in the Asian session, these might not exactly, just looking at the change percentages when the markets are not open. In other words, when the stock market is not open, might not be the most reliable indicator. So there's another way that I want to go about it, guys. But the very first thing you can do is look at during the current session, sort by change percentage, and look at which one of the instruments has moved the most, the greatest amount of delta. The next item to mean reversion trade is using something like Bollinger Bands. So for example, Bollinger Bands are designed such that depending on the settings that you use, here's the default settings, guys. There's a 20-period simple moving average in the middle there on that blue line, and then the lower green line is what's called the second standard deviation below the 20-period simple moving average, and the red line to the top is a second standard deviation above the 20-period simple moving average. Now, according to mathematics, something should not be trading below the second standard deviation greater than, it's within that Bollinger Band 66% of the time, or 2/3 of the time. I believe that is correct. And then if it's above the red line, it should be trading below that red line 66 spot 2/3 of the time. Okay. So in other words, the markets should not spend too much time above or below the green line or the red line. That means they shouldn't spend more than 1/3 of the time using the standard deviations above or below the bottom Bollinger Band or the top Bollinger Band. Now, guys, what you can do if you want to increase your mean reversion trading accuracy is you can open up the Bollinger Bands to the third standard deviation. So, for example, now that I've opened it up to the third standard deviation, so again, all I'm going to do is I'm going to click on that blue line. It's going to bring out the Bollinger Bands, and the standard deviations I'm going to bring to 3. Now, using the third standard deviation, price should remain within the bottom green line and the top red line 99% of the time. Okay, so that brings it up to it virtually should never trade below the green line or the red line. The idea of mean reversion trading is that when the market extends beyond the second or the third standard deviation Bollinger Band, whichever setting you're using, right now we're on the third standard deviation, if you see the market trade to an extreme, you're going to want to trade in the opposite direction, okay? Betting that the market is going to revert or mean revert back to an average price. It's very, very simple, guys. So, for example, if we can see here, I'm going to point out an example of where this would have worked. If you would have bought corn futures somewhere around here, you had an easy trade back to the 20 period simple moving average. Now let's have a look at the, let's see here, the NASDAQ is what I want to find. Okay guys, this is the NASDAQ, all right, with a third standard deviation Bollinger Band. The idea behind mean reversion, again, is that the market should not spend so much time above or below the bottom band or the top band. All right, so looking at some examples of where a mean reversion trade using the Bollinger Bands would have worked, we can see that the market came down and rode down this third standard deviation Bollinger Band. And somewhere around here, it started to mean revert. Okay, and the same thing here, mean reversion here, and then mean reversion here. So guys, the idea behind this is the market's going to mean revert back from the second or the third standard deviation Bollinger Band. Is this always going to work? No. In trending markets, when the market is trending in one direction or another very strongly, the market's going to ride that upper Bollinger Band. It's going to ride the lower Bollinger Band. In other words, this is not the best strategy for a strong trending market. However, there are a lot of different trading strategies out there, and the idea behind this channel is I want to give you different strategies. So mean reversion using a second or a third standard deviation Bollinger Band is one of the ways that you can trade, and plenty of traders use this strategy. Let's have another look at an example of using the third standard deviation Bollinger Band. So here's gold futures. When gold futures popped above that third standard deviation Bollinger Band, notice that the market came back down a bit and mean reverted. Okay, another example is here. The market hit that third standard deviation Bollinger Band, and it mean reverted a bit. Okay, same thing here, same thing here. We got close here, and then this would have been a pretty strong trade if you got in here. My recommendation, if you are a conservative trader, that is, your number one goal is to preserve your capital and not take on so much risk. My advice, so this is not financial advice, but again, if you want to mean revert using a fairly risk-averse strategy, use the Bollinger Bands and set them to the third standard deviation. When price exceeds the upper Bollinger Band, sell. And when the price dips below that third standard deviation Bollinger Band, as in when it dips below that green line on the bottom there, buy. Very simple strategy, guys. The idea is that when the market moves too far, too fast, it makes an extended move, we're going to bet that the market is going to mean revert to some extent. Okay, guys, but this is not the only way that you can use mean reversion. Let's go over to the RSI, the Relative Strength Index. This is another item to look at. Okay, guys, so if you are interested in a mean reversion style of trading, another option, if you're using indicators, another option for you is have the Bollinger Bands on and see if the Relative Strength Index goes overbought or oversold, which is another sign that the market has extended itself too far to the upside or too far to the downside. Now, guys, no trading strategy is foolproof. I want to reiterate this. In a strongly trending market, it is not likely to mean revert. However, the majority of the time, markets like to stay within confined ranges, at least for a period of time. So with that being said, this is a pretty reliable strategy if you stick conservatively and stick consistently with it. So the other tool that you can use for mean reversion trading here is the Relative Strength Index. And if you also pair that with a third standard deviation Bollinger Band, you've got a very conservative, very risk-averse strategy that should work out more often than not. There are other tools, guys. So, for example, instead of using the Relative Strength Index, we can use another oscillator. So, for example, we have some of these RSI. There's also stochastics. Okay, stochastic. We're going to put that on. Now, guys, similar to the RSI, it's an oscillator that has an overbought and an oversold line. I do not like using this stochastic as much as I do the RSI, and rarely do I use indicators to begin with. I think personally the third standard deviation Bollinger Band is conservative enough. However, I don't have all the answers, so if you want to know your options, you have stochastics as well. very similar to the RSI. It's going to show you when the market has made an extended move in one direction or another. If you use one of those tools combined with the third standard deviation Bollinger Band, you have a very conservative, sort of risk-averse, high probability strategy. But nothing is perfect, guys. Okay, so let's take those off the screen and let's talk about mean reversion as opposed to momentum. Now, I'm also going to get into a strategy on momentum, but I want to start here with mean reversion. Okay, so momentum is where you're making a bet, so to speak, that the market's going to ride that upper Bollinger Band or ride the lower Bollinger Band. Okay. In other words, a sort of breakout trading is another way to call that, or momentum trading. And it's the opposite of mean reversion trading. Now, at hedge funds, what do? Hedge funds have multiple desks, one that's implementing a mean reversion strategy, one that's going to implement a momentum strategy. And so overall, the idea is that the hedge fund's going to make money. So if you had to ask me between mean reversion and momentum trading, which one do I prefer? I prefer mean reversion trading. So if you're asking me personally, which of these strategies would I prefer? I like having the third standard deviation Bollinger Band on the screen. I like to know when these markets have made an extended move so that I can bet in the opposite direction. And that's my preference. Okay, guys, so with that being said, this has been an overview of mean reversion trading using Bollinger Bands, using the RSI, and using the stochastics. The basic idea, again, I just want to recap this video. The basic idea behind mean reversion is that when a market has moved too far, too fast, you're betting in the opposite direction. Using a tool such as the Bollinger Bands, the RSI, or other tool set. And that's the idea behind mean reversion trading, guys. This has been Our Trades, back with another video. Please make sure to like, comment, subscribe, and I sure hope to see you in the next one.